Hey everyone. Today we're talking about 5 reasons why you should think twice before getting into an annuity. And so I'm Cary Smith. I'm sitting here with Cheri Turner. We're both with Client First Capital. And hey, Cheri, let me just lead off with I like annuities. I've been, in my corporate job prior to this, I've been responsible for annuity sales and have ran annuity strategies and things of that nature. So I I like annuities, but I
Mhm.
also know that they're not right for every situation. They're
Right.
not right for every person or portfolio.
Mhm.
They have they have situations where they fit really well, but I also know when you look at the larger industry, there can be a lot of risk and a lot of things to be aware of, or maybe even be cautioned about. So we're going to talk about some of those things today.
Mhm.
And so again, we got 5 reasons that would cause you to think twice before you get into an annuity, which basically is a long-term insurance contract. And we'll
Right.
talk a little bit more about that. But why don't you kind of kick us off into this discussion?
Right. Absolutely. So we'll start with what I believe to be the biggest red flag when it comes to annuities, and that's the fees. Most people assume that annuities are simple, low cost products. After all, they're marketed as safe, stable, and guaranteed. But what's often left out of the conversation is that annuities can come with multiple layers of fees, and they add up quickly. Here's what you might be paying for. First, there's what they call the mortality and expense risk charge. This is the insurance company's way of covering their own risk, essentially a built in profit margin that often is around 1 to 1.5% per year. Then there are the administrative fees, basically the cost of record keeping and managing your account. And that's another quarter to half percent that's gone. Next, you have the investment management fees. And if you have a variable annuity, your money is often placed into sub accounts, kind of similar to mutual funds, and those come with their own management expenses as well. And that's not all. If your annuity includes any riders, like guaranteed income rider or enhanced death benefits, long term care features, each one of those can cost an additional half percent to 1% per year or even more. So when you add it all up, it's not uncommon to see total annual fees between 3 and 4% every single year. Now, that might not sound like that much at first glance, but over 10, 15, 20 years, those fees can quietly add up to tens of thousands or even hundreds of thousands from your retirement savings in a large annuity. And the kicker is that these fees are often buried in the contract or spread across multiple line items. So they're rarely disclosed clearly during the sales pitch. And you may not even realize how much you're paying unless you go line by line through the paperwork or ask very specific questions. So the bottom line is before you sign anything, always ask what are the total all in annual costs and then get it in writing.
Okay, so that's really good, Cherie. And so it sounds to me like although high fees and hidden cost maybe the reason that we have there to be to think twice. I would also maybe rephrase it another way and just say complexity, right?
Mhm.
Because a lot of times those fees and hidden cost hide in the complexity of a contract, right?
Right,
and
right.
and and so yeah, so there's um, um, high and hidden fees, right?
Mhm,
Which I would
mhm.
say can be hidden within the complexity. Okay, let's move on to the reason number 2.
Right. So the second major reason, and it's kind of to what you were speaking of, and that is complex rules and conditions. So there's not just complexity in the billing, but there's other types of complexity involved. Annuities are often marketed with appealing language, things like guaranteed lifetime income, minimum returns, or principal protection. On the surface, that sounds great, especially if you're nearing or in retirement. But here's the part that most people don't hear: those benefits almost always come with strings attached, and sometimes not small ones. For example, some annuities require you to wait as long as 10 years before you're eligible to receive the full benefit of the guarantees you paid for. That means if your situation changes or if you need access to your money earlier, you could miss out entirely or face severe penalties. And then there's annuitization. That's when you agree to trade your annuity balance for the steady stream of payments, usually for the rest of your life. Now, it might sound like a safe and predictable option, but here's the catch. Once you make that choice to annuitize, you no longer have access to your original money. You can't change your mind later and ask for a lump sum back. The insurance company now controls that money, and you're locked into the payment schedule that you've set. There are rare exceptions, but it's almost always a permanent decision you can't undo. Then another major issue, severe penalties for canceling or changing the contract. If you decide before annuitizing that the annuity no longer fits your needs, or you identify a better investment, you'll likely face surrender charges, which often start as high as 7% or more, and then gradually decline over several years. In some contracts, those penalties last for a decade or longer. These costs can really eat into your retirement savings in a big way, just for trying to access your own money. And then one other restriction are limited investment options. With many annuities, especially those offering income riders or guaranteed withdrawal benefits, you're not allowed to invest however you like. The insurance company may restrict your portfolio to lower return and conservative investments to reduce their own liability. That means your growth potential is often limited, even though you're still paying the full cost for those benefit guarantees. And then something that's critical is that if you don't follow every rule as outlined in the contract, whether it's contribution limits or the timing of your withdrawals or how your money is allocated, you may actually lose the benefits that you thought you were paying for. And if life throws you a curveball, and as it often does, your annuity may not be able to adapt. Unlike a brokerage account, which gives you flexibility and control, annuities operate in a very tightly controlled box. And once you're in, it's very difficult to make changes. So the bottom line is, before buying an annuity, ask yourself, do I really want to lock up my money under these kinds of conditions? Because the fine print really matters a lot.
So a couple of things on annuities. With a lot of annuities, you can withdraw up to 10% a year without some penalties. But what I would say is, if there's any chance that you're going to need access to that money through an emergency or any other reason before you're able to get that money out without penalties, you really need to consider, is this a suitable alternative for you or not?
Right.
Because if you're going to need access to those assets prior to passing any surrender fees, it may not be the right thing for you.
Right. Good point. So something else that's often overlooked is limited growth potential. When you buy an annuity, especially a fixed or indexed annuity, you're essentially agreeing to a cap on your upside. That means no matter how well the market does, your returns are typically limited by the rules in your contract. Take indexed annuities, for example. They're often tied to a market index like the S&P 500, but they might cap your annual gain at 5%, even if the market returns 10, 15, or more. Some annuities also include what's called a participation rate. So if your participation rate is 80% and the market earns 10, you're going to get only 8%. So what does all this mean in real dollars? Over time, that kind of drag can really add up. While the market might average 8 to 10% annually, your annuity might only deliver half of that or less after you consider fees, caps, and restrictions. So you're trading long-term growth essentially for the illusion of safety. And for retirees who need their money to last 20 or 30 years, that trade-off could mean potentially falling short of your goals. So the bottom line is, if growth is important to your retirement plan, make sure that you understand how much potential you're giving up before committing to the annuity.
So that's a really good point. So a lot of these index annuities will give you some protection on the downside, right? Which is good, right? And but to your point, where you're not performing as well, or where you're, you have limited growth potential is if the index that you're invested in, or your annuities invested in, is performing really well, you may not be participating fully. And so
Right.
the loss may be there, right? Even though you have some downside protection. Okay. So that was reason number 3. Let's talk about reason number 4.
Yes. So let's take a minute to talk about something that rarely gets attention when it comes to annuities, and that's taxes. Annuities are often promoted as offering tax deferred growth, which sounds appealing. And yes, it's true that while your money is inside the annuity, you don't pay taxes on those gains year to year. But what most people don't realize is that when you finally withdraw that money, it is taxed as ordinary income. It's not taxed at the lower capital gains rates that you would get if you had a long-term stock investment. So if you're in a high tax bracket, that tax hit could be steep. Now, what if you bought your annuity inside a retirement account like an IRA? Unfortunately, you don't get any additional tax advantages. You're just layering an annuity on top of a vehicle that's already tax deferred. But you're still paying all the annuity's internal fees. So you're not gaining anything, but you're definitely paying more within that. And then it gets worse when you consider what happens after you pass. Your heirs who can inherit your annuity don't get any kind of step up in cost basis, which is something that they would get with stocks or mutual funds. Instead, any gains on the annuity are fully taxed to them as ordinary income as well. So that could mean a much larger tax bill than they'd expected. So the bottom line, from a tax perspective, annuities are often one of the least efficient in your financial toolbox. So that's something every investor really needs to consider before they buy.
Okay, those are really good points, Cheri. So, so let's jump into reason number 5.
Mhm. Finally, let's talk about inflation, often called the silent killer of retirement income. Over time, inflation quietly erodes your purchasing power. So here's the problem. Most annuities do not adjust for inflation. That means the income stream that feels comfortable today may not meet your needs down the road. So let's put that in perspective. If you start annuitizing and you receive $50,000 a year, and inflation averages just 3% annually, which is about the historical average, what happens next? Well, in 10 years, your $50,000 will only buy what 37 buys today, 37,000. In 20 years, that shrinks to about $28,000. And in 30 years, it's worth just $20,000. That's a dramatic decline in purchasing power. And remember, retirement can last decades, especially with increasing life expectancy. So you could be living on that fixed income while everything else around you, your groceries, your healthcare, and travel, continue to rise in cost. And now, to be clear, a number of annuities do offer an inflation rider or cost of living adjustments, but they do usually come at a steep additional cost. And even then, the protection might be either limited or capped as well. So unless you've specifically added and paid for inflation protection, and most people haven't, you're locking yourself into an income stream that's really losing value every single year. So the bottom line is that predictability isn't the same as security. Without growth that keeps pace with inflation, that steady annuity check may feel more like a shrinking lifeline over time.
Okay. So, Cheri, you've covered a lot of good reasons why a person should think twice before getting into an annuity. High and hidden fees, right? They can be complex and have a lot of rules and conditions. Limited growth potential, unfavorable tax treatment, and then the risk of inflation risk, right? Of your benefit being impacted by inflation. So, so Cheri, why don't you wrap us up on this topic?
Yeah. So although we're talking about the disadvantages, does this mean you should never consider an annuity? Not necessarily, no. But you should go in with your eyes wide open. Be sure to ask the proper questions, read the full contract, and talk first with an independent fiduciary financial advisor, and preferably one who does not sell annuities, in order to decide if it makes sense for you.
Okay. Hey, Cheri, thank you for this topic, and thank you for the insights that you've given us. And for everyone else, thanks for watching. If you found this video helpful, give us a like and it helps other people find our content. Also, if you have a question about annuities or maybe some of the low-cost alternatives to an annuity, feel free to put those in the comments as well. We'd love to engage in conversation with you as well. And if you're planning for retirement or would like to have a second opinion on your strategy, give us a call. We'd love to give you a free financial consultation. And so just reach out to us. You can reach us at clientfirstcap.com. And from there, you can sign up for our newsletter, schedule an appointment, or just give us a call. But thanks, everyone, for watching. And Cheri, good job.
Thank you.